Welcome to my rapidly growing YouTube channel. For a chance to win a $50 gift card, please subscribe to my channel, hit the like button, and leave a comment below. What exactly is a recession? A recession is a macroeconomic phrase that denotes a large drop in overall economic activity in a specific area. It was previously defined as 2 consecutive quarters of economic contraction, as measured by GDP and monthly indicators such as an increase in unemployment. However, according to the National Bureau of Economic Research, which officially proclaims recessions, a recession is defined as a considerable drop in economic activity across the economy that lasts longer than a few months. Indicators of a recession include real GDP, industrial production, employment, real income, and wholesale retail trade. Although the National Bureau of Economic Research does not require 2 consecutive quarters of negative economic growth as measured by a country's gross domestic product to declare a recession. It does, however, use more frequently reported monthly data to make its decision, so quarterly GDP declines do not always coincide with the decision to declare a recession. Most countries' long-term macroeconomic trend has been economic expansion since the Industrial Revolution. Short-term volatility have accompanied this long-term expansion, with major macroeconomic indicators slowing or even decreasing for periods ranging from 6 months to several years before resuming their long-term growth pattern. Recessions are the name for these short-term falls. The business cycle includes recessions, which are a normal, albeit unpleasant, part of the process. A spate of corporate failures, including often bank failures, weak or negative growth in production, and high unemployment characterize recessions. Even if recessions are only temporary, the economic misery they create can have significant consequences that transform an economy. This can happen as a result of structural changes in the economy, such as vulnerable or obsolete firms, industries, or technologies failing and being swept away, dramatic policy responses by government and monetary authorities, which can literally rewrite the rules for businesses, or social and political upheaval caused by widespread unemployment and economic distress. Investing in companies with minimal debt, good cash flow, and robust balance sheets is one of the best options for investors during a recession. Avoid companies that are heavily leveraged, cyclical, or speculative, on the other hand. There is no one-size-fits-all method for predicting how and when a recession will strike. Apart from 2 consecutive quarters of GDP decrease, economists look at a number of indicators to see if a recession is on the horizon or already underway. Many economists believe that there are a few widely accepted indicators that, when combined, can indicate the possibility of a recession. First, there are leading indicators, which have traditionally shown changes in their trends and growth rates before macroeconomic trends. The ISM Purchasing Managers Index, the Conference Board Leading Economic Index, the OECD Composite Leading Indicator, and the Treasury Yield Curve are examples of these indicators. These are crucial to investors and commercial decision makers because they can predict a recession ahead of time. Second, there are publicly released data series from various government agencies that represent significant sectors of the economy, such as the United States Census Bureau's housing statistics and capital goods new orders data. Because these statistics are used to determine the components of GDP, which will ultimately be used to define when a recession begins, changes in these data may slightly precede or move in lockstep with the onset of a recession. Finally, lagging indicators, such as an increase in unemployment rates, can be used to corroborate an economy's shift into recession after it has begun. Several economic theories have been proposed to explain why and how the economy could deviate from its long-term growth pattern and enter a short recession. These theories can be classified as being based on genuine economic, financial, or psychological considerations, with some theories bridging the gaps between them. Real changes and structural alterations in industries, according to some economists, are the best explanations for when and how economic recessions occur. A sudden, persistent rise in oil prices owing to a geopolitical crisis, for example, might raise costs across several businesses at the same time, or a breakthrough new technology could quickly render entire industries obsolete, precipitating a broad recession in either case. The emergence of the COVID-19 epidemic in 2020, as well as the following public health lockdowns in the economy, is an example of the type of economic shock that might trigger a recession. It's also possible that other underlying economic tendencies are driving the economy toward a downturn, with the economic shock just triggering the tipping point into a slump. Some hypotheses claim that recessions are caused by financial issues. These normally concentrate on either the overexpansion of credit and financial risk prior to a recession, or the contraction of money and credit at the outset of a recession, or both. This sort of theory is exemplified by monetary theory, which blames recessions on insufficient money supply expansion. The Austrian business cycle theory explores the links between credit, interest rates, the time horizon of market participants' production and consumption plans, and the structure of relationships between certain types of productive capital goods to bridge the gap between real and monetary elements. Psychology-based recession theories tend to look at the preceding boom's excessive enthusiasm or the recessionary environment's deep pessimism as reasons for recessions to emerge and to continue. Keynesian economics falls squarely into this category, as it points out that once a recession starts, for whatever reason, investor pessimism can become a self-fulfilling prophecy of reduced investment spending based on market pessimism, which leads to lower incomes, which in turn leads to lower consumption spending. Minskyite ideas combine psychological and financial aspects to hunt for the cause of recessions in financial market speculative excitement and the building of financial bubbles built on debt that inevitably implode. Recessions and depressions are two terms used to describe periods of economic downturn. According to the National Bureau of Economic Research, the United States has experienced 34 recessions since 1854, with the most recent one occurring in 2020. There have been 5 such periods of negative economic growth since 1980, all of which were classified as recessions. The worldwide recession that followed the 2008 financial crisis and the Great Depression of the 1930s are two well-known examples of recession and depression. A depression is a severe and long-term economic downturn. While there are no particular criteria for declaring a depression, the Great Depression was marked by a 33% drop in the quantity of goods and services produced in the United States, an 80% drop in stock market value, and an unemployment rate that temporarily reached 25%. Simply put, depression is a long-term state of mental illness. I hope you find this information helpful. For a chance to win a $50 gift card, subscribe to my channel, like the video, and comment. Bye for now.